Welcome to ForexTV.com's PM Exchange. It's Monday, December 17th. I'm Remy Hokie. Today I'm joined by Michael Woolfolk from the Bank of New York Mellon. Good afternoon, Michael.
Yes, hi. Good
Thanks
afternoon.
for joining us
Yes.
today.
Thank you.
Well, it's hard to believe, but we're nearing year-end, and historically, we see U.S. dollar weakness in the month of December. But in the previous session, and also today, the U.S. dollar has gained against the euro and sterling, as well as the other majors, as we've seen the dollar index edge higher. But let's take a step back and given central bank outlook as well as this morning's U.S. data, especially tick data, if you could give us your Fed rate outlook and how you see this weighing on the U.S. dollar as we head into '08.
Well, the Fed rate outlook does not look the same as it did 2 weeks ago before the CPI and PPI data released from the U.S. last week, which showed faster than expected rise in inflation. Food and energy prices are rising very rapidly right now, not only in the United States but overseas. For the ECB, that has kept them from considering any rate cut for the time being, probably rightly so. Whereas in the U.S., Canada, and in the U.K., central banks have been more willing to overlook that because of the slowdown in their economies and core inflation remains low. However, we do see a little bit of spillage over in the core inflation, both the CPI as well as PPI, and that has cut back on market expectations of Fed cuts. Not necessarily the direction, but the magnitude of Fed cuts. It is going to be curbing the Fed's ability to cut interest rates if there's a visceral threat to price stability. So January will be a very interesting decision. The upcoming Fed meeting, I think the market is right in expecting a 25 basis point cut. If the Fed doesn't cut, that may be kind of the first step towards, let's say, starting a kind of a stagflation type of environment where the Fed cannot cut to stimulate growth due to inflation. That would remain a problem. Really, I mean, you take a look at the data today, the TICS data, the current account data of the U.S., it appears that the weaker dollar and strong growth overseas is at once encouraging U.S. exports due to the weaker dollar and stronger overseas growth, but also curtailing our imports, our demand for imports as growth here slows. So these numbers are improving. We now have a current account deficit in the third quarter of only 5.1% of GDP. That should be stable. And we had a very significant surprise to the upside with respect to the TICS data. So we're now adequately funding our current account deficit. So this argues really for dollar stability. Now you match that with the data, the inflation data of the U.S. last week, which suggested maybe that the Fed will be more cautious about cutting interest rates, and it's a strong dollar scenario, if not certainly a stable dollar scenario. And I think that the dollar right now is benefiting from that. It's benefiting from the decline in equity markets and risk averse type of safe haven bid, and we see that continuing at least for the next several trading sessions.
Well, Michael, as you mentioned dollar stability in the previous session on Friday, and also today we saw the euro see weakness against the dollar. But as we end today's session, the euro is edging back near the 144 level. Given rate differentials, and also if you could tell us whether you think this is more position squaring and profit taking.
Well, there is certainly a very strong squeeze of short dollar positions right now, and there is in addition a change in perception about interest rate differentials in the U.S. versus overseas, but nonetheless going forward here, you're looking at kind of the 3 to 12 month horizon. The currency that looks best positioned to gain really in the G7 is the Eurozone, the euro currency. That's probably not what Europeans want to hear, but that's kind of the reality of it, with the ECB the least likely to cut rates, and most likely to increase rates really amongst the G7 at this stage. So we do see benefits to the Eurozone and the euro currency, and not so much of a threat really to growth fundamentals there. So we're looking at 144 now. What's more likely, 140 or 150? I think the odds are that we see 140 first.
Okay, Michael, moving on to the sterling. Tomorrow morning we'll be getting CPI data out from the UK, and also on Wednesday we'll get the BoE minutes from the latest BoE meeting. And in afternoon trade, sterling is trading around 202.15, seeing a little gain from earlier this morning. But do you expect sterling to pull back to below the $2 handle anytime soon?
I think that certainly it is in the cards. It is something that would probably be a positive for the economy. I think that policymakers would not have much of a problem with it breaking below 200, so long as they did it in a measured, gradual basis. Is it likely? It really depends upon the data. I mean, if the data out tomorrow is soft and provides the Bank of England with further room to cut, sure, particularly if it's backed up by meeting minutes suggesting that there is overwhelming support for further cuts, that it isn't just a one-off here. So, I mean, we could see not only break below 200 in cable, but sterling yen and the cross could be breaking below 225, making its way actually towards the 220 level. And I think that the euro-sterling cross could also, I think, surprise a lot of people on the downside, particularly if you have some hawkish rumblings by the ECB. Where the euro-sterling cross, we're at about 71.2 cents. I would say that we could get up easily above the 72 handle, if not make good progress towards 73 before the end of the week.
Okay, Michael, you just mentioned some of the crosses, so let's take a look at the yen crosses, including the major of dollar yen. Well, in today's session, U.S. equities have started the week lower, and it's still under negative territory, but we're seeing the dollar taper off around the 113 level against the Japanese currency. So if you could give us your forecast for dollar yen as well as the yen crosses.
What we're seeing today, Remy, and what may likely unfold as the week progresses, is some risk aversion out there, some safe haven bids. It's cutting back on yen carry trades. So even though the dollar seems to be benefiting from the safe haven flows, the yen seems to be also benefiting from a curtailing of yen carry trades. So dollar yen could drift back above 113 towards 114 or so. I wouldn't expect much more progress than about 114 in the coming week. However, if you look at something like sterling yen, with were sterling to break below, let's say, 200 against the dollar, as we were discussing earlier, this would be, I think, a very good signal for some considerable downside in sterling yen, perhaps, as I mentioned, back towards the 220 level. The euro yen, a little less so. Again, Trichet has been very clear about his one needle on his compass, that he's bound and determined to meet any threat to price stability with firmness. So I think that the euro, amongst the non-dollar currencies, I think the euro at the margin does better. So euro yen might be a push. I'm not sure that we're going to necessarily break out of this kind of 160 to 165 euro yen cross. Aussie yen is a completely different topic, however. I think Aussie yen, the Kiwi yen crosses, there's definitely some downside mobility there, largely because these are very popular yen carry trades in the region, and Aussie and Kiwi are coming under some pressure.
And while we're still on the topic of carry trades, we've seen Euro Swissy taking a hit, and it was last trading around 165.60. Overnight, we had solid data out from Switzerland, and also with the decline in U.S. equities, we're seeing Euro come down against the Swissy. What's your forecast for the Euro Swissy cross?
Well, actually, in more the 3 to 12 month horizon, we're much more optimistic about Euro Swiss. We think that the Euro economy is more likely to benefit from upside surprises in the economy, global growth, and is likely to run advantageous interest rate differentials going forward. The Swiss National Bank is far more willing to cut interest rates were that to become an issue. So, I mean, we're at 165.60. I don't see any problem with trading below 165, reflecting maybe at the margin a little bit more Swiss franc strength here. But the carry trade funding currencies, the Japanese yen and the Swiss franc, are definitely getting their comeuppance now after having been sold heavily earlier in the year. But then again, I think the medium to longer term outlook really does favor Euro strength against the Swiss franc and the yen because of the interest rate differentials and favorable growth fundamentals for the Eurozone.
Okay, and Michael, last but not least, before we wrap it up, if we could just take a quick look at the data front this week here in the U.S. We have more housing data with housing starts data coming out, and also personal income and spending and Q3 final GDP.
Sure.
Well, given that next week is a holiday week in many major economies, if you could give us your take on what Forex traders should be watching out for as we head into year end.
Well, certainly, Remy. You'd mentioned most of the major releases out of the U.S. I mean, this will be the last week of the year that we truly have liquidity in the market, and we're focused on economic releases and fundamentals. And perhaps the most important focus will be, as you mentioned, U.S. GDP on Thursday, U.S. personal income and spending on Friday. We're going to see the market begin to dry up on Friday going into the holiday weekend. I see personal income and spending anything above about 0.2%, either on personal income or personal spending, is likely to kind of reinforce the, I think, the renewed optimism about a soft landing next year. The U.S. consumer has, again, stood up in the face of tremendous headwinds of a rising interest rate, of rising energy prices, of a crisis in the credit market, whatnot, and has continued to spend. So it's been a very, very fortunate outcome, and we are likely to see some further deterioration in the building permits, housing starts tomorrow. So don't be surprised to see anywhere from 1 to 3% decline in those housing variables. But again, it's just managing a crisis. What we want is to see a measured and orderly decline in housing starts, purchases, and housing prices. We're starting to see some weakness come out of the housing sector in the UK. We saw that today, so we have to be very vigilant about that to ensure that that doesn't become an issue for growth. You have also out of Canada, Canadian retail sales and Canadian GDP this week. Retail sales happens to be one of the number one monthly indicators for Canada. And I mean that is an important economy. That's an important currency right now, and it's in play. And we could break back below parity in dollar Canada terms. Were I think a lot of the concerns about Canada put aside. Were energy prices to rebound. We have Canadian CPI also to come out this week. So if that we saw a surprise in terms of Canadian CPI, much like what we've seen here in the States last week, that could effectively curtail the Bank of Canada's ability to cut interest rates further, which would be good for the currency. So if you have that above expectations on Canadian CPI, Canadian retail sales, GDP comes out also on Friday for Canada. If you could get a very bullish scenario pushing us back below parity.
Okay, Michael, as always, thank you very much for coming on the show.
Thank you for inviting me.
This has been your Forex News with Michael Woolfolk from the Bank of New York Mellon. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks started off the week in negative territory, with the major indexes ending down over 1% on the day. The tech-heavy NASDAQ took a hit, down by 2.3% for the session. Wall Street remains concerned about inflation and economic growth in the U.S. In today's economic data, the NAHB reported that its home builders housing market index stayed at 19 for the third consecutive month in December. Meanwhile, the Empire State Index fell sharply by 17 points in December for a reading of 10.3. In November, the index only fell slightly to 27.4. New orders for the index also fell to 14.3 from 24.5. And net foreign purchases of long-term U.S. securities surged in October to $114 billion versus the $15.4 billion in September. And net inflow into the U.S. was at $97.8 billion. Also, the U.S. current account deficit narrowed to $178.5 billion in Q3. At the closing bell, the Dow Jones Industrial Average tumbled over 172.5 points, ending at 13,167.20. The Nasdaq plunged 61.28 to 2,574.46, and the S&P 500 fell 22, ending the session at 1,445.90. In the fixed income market, U.S. Treasury bonds rallied on the day. Investors turned to Treasuries seeking safe haven assets as we head into the holiday season. There is increased likelihood for volatility and thin trading conditions, especially given the turbulence in the financial markets. The benchmark 10-year Treasury note rose with the yield at 4.19%, down from 4.24% late Friday. The 30-year bond gained with the yield at 4.62% from 4.66% late in the previous session. And the 2-year note rose with the yield at 3.24%. And in energy, NYMEX crude oil futures fell for the third straight session. Weighing on prices today was news that OPEC may increase production at its meeting in February '08. January crude ended the session down 64 cents at $90.63 a barrel. Crude futures fell below $90 earlier to an intraday low of $89.49 in electronic trading. Elsewhere on the NYMEX, January RBOB gasoline fell 0.63 cent, ending at $2.33.54 a gallon. January heating oil fell 1 cent to close at $2.59.79 a gallon. Meanwhile, January nat gas futures were down at $7.021 per million BTU. And in the metals complex, gold futures ended the session with a small gain. February gold gained $1.30, ending at $7.99.30 an ounce on the NYMEX. Meanwhile, COMEX March silver fell 0.3 cent to $13.98. In other metals, January platinum added 24.40 to end at $1,503.60 an ounce. Meanwhile, March palladium added $3.95, ending today's session at $361.35 an ounce. This afternoon, we're joined by Paul Britton, analyst at Aileron Trading. He'll recap today's session in energy and metals futures and also give us his commodities outlook for the week ahead.
Good afternoon. This is Paul Britton with Aileron Trading out here in Las Vegas, Nevada. Today in the energy markets, crude oil prices dropped nearly $2 today to trade below $90 a barrel after the next president of the Organization of Petroleum Exporting Countries, that'd be OPEC, said the cartel may increase production at its next meeting in February. Crude oil prices fell for January down at $1.67 or 1.8% to $89.60 a barrel on the New York Merc in late morning trading. Earlier, it was down even more at $1.78 to an intraday low of $89.49. Anyway, Algeria oil minister Kahib Khalil is going to take over as next president of OPEC, and he was talking down the price of crude. They're saying that there's no need to, that they're looking to increase production, and we should have substantial supplies. Now, all this, with crude oil down, is in the face of, two other big problems. Number one, all the storms across the U.S., as well as some warring actions over in Nigeria. They're doing an armed revolt in Nigeria against the Nigerian Delta to unite they're crippling Africa's petroleum industry. That according to the AP. Anyway, so it's pretty strong for crude oil to be down this much in face of, the weather we're seeing across the United States and the fact that we might be taking Nigeria off the map as far as an oil producer. Anyway, it's also today in gasoline, we have gasoline down over 2 cents to $2.32 a gallon. Heating oil is down 2.65 cents to $2.58 a gallon, and natural gas also fell 5.8 cents to 6.96 per million British thermal units. From there, we go over to the metal markets. We also saw silver and gold also weaker today. No big surprise there, since gold pretty much follows the price of crude oil as well as the strength of the dollar. The strength of the dollar was a little bit stronger again today. Gold for February delivery dropped $3 to $7.95 an ounce in New York. Weaker oil and stronger dollar weighs on that. And then in silver, fell down 3.3 cents to finish at $13.95. December copper fell 6.15 cents and finished out the day at $2.87 per pound. All right, that's all we've got for you today. I want to thank you for coming. My name is Paul Britton, and it's Aileron Trading.
That was Paul Britton, analyst at Aileron Trading, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.